That's it from us. Sally's here next. Bye for now.
Now on BBC World News, the latest business news from across the globe. World Business Report.
Global banking shares continue to slump following the collapse of Silicon Valley Bank. Will central banks now hit pause on raising rates? And the UK's unemployment rate remains unchanged, but concerns rise as wages remain static too. We get an expert view. Hello and a very warm welcome. You're with World Business Report with me, Sally Bundock. And we start with the continuing fallout following the collapse of Silicon Valley Bank. Investors are still on edge after banking shares saw heavy drops on Monday in the US and Europe. So today in Asia, the selling continue with Japan's largest banks seeing some sharp falls. Shares of MUFG, Mizuho and SMFG were all down around 8% during their trading session. The Nikkei 225 was down over 2% for most of the day. On Monday, major US banks lost around $90 billion in stock market value, bringing their loss since SVB's collapse to nearly $190 billion. Many are now speculating the Federal Reserve will pause its plans to keep raising interest rates designed to tame inflation. Here's our North America business correspondent, Michelle Fleury in New York.
What the havoc in the US banking sector means for the broader economy remains to be seen, but it's already changing calculations about how America's fight against inflation may play out. Economists at Goldman Sachs no longer expect the US Federal Reserve to raise interest rates at its meeting next week, saying policymakers won't want to undermine their efforts to restore financial stability by hiking rates just a few days later. The Wall Street Investment Bank had forecast a quarter-point increase before this week. The argument for pausing, well, it's twofold. It would allow more time for financial stability to be restored, plus this event could very well exert downward pressure on prices if banks pull back on lending. We'll get a clearer picture of inflation later this Tuesday with the latest consumer price index reading. The Fed will be hoping the data is muted. Otherwise, their job of tackling inflation and ensuring financial stability while avoiding a recession will get that bit tougher.
Michelle Fleury there. So let's turn our attention to the UK. We've just had the latest jobless numbers showing the unemployment rate remaining unchanged at 3.7%. That was in the 3 months to the end of January. So this is a multi-year low, with many sectors struggling to find the workers they desperately need. What's interesting though as well is wages didn't go up. So tomorrow it's budget day in the UK, and it's expected the Finance Minister, or Chancellor of the Exchequer as we call him, will announce measures to encourage the so-called economically inactive back to work in order to boost growth. And one target group is the over 50s. Well, let's talk to Dan Kemp, who's Global Chief Investment Officer at Morningstar Investment Management. Good morning to you, Dan. Let's talk about the numbers to begin with. Unemployment remaining at 3.7%, which was expected. Wages not rising. Is that good news or bad news? I mean, Andrew Bailey at the Bank of England will be very pleased to hear that, won't he?
There's always something to worry about, Sally, and you're right. So people will be focused now on wages. The thing to remember as we contextualize these numbers is that wages, nominal wages, have been rising, but of course inflation has been so high that people aren't seeing their real wages. That's wages after inflation rising. So everybody feels poorer, even though nominal wages are increasing. Now, of course, the thing to remember as we look forward is that wages are what you're going to earn in the future, whereas inflation is what happened in the past. And so that's why we have to balance this forward-looking view on wages and employment, which, as you say, is at multi-decade lows, and that's really good news, with this high inflationary period that we've just been through. So it is a much more nuanced picture than either worrying about what's happening with wages or being overly positive about what's happened in jobs.
We'll get inflation numbers out of the US today as well, and that will be read very carefully by the US Federal Reserve. Your thoughts?
Yes, so the forecasts are expecting inflation in the US to fall from about 6.4% to about 6%. So that's a very positive view and reflects this ongoing narrative of declining inflation in the US. So if that happens, then there'll be less pressure on the Federal Reserve, and those comments we heard earlier from Michelle, the forecast from Goldman's may well be right. But of course, if inflation remains sticky, and it is a measure with a lot of noise, then that may throw everything into confusion, and people will be concerned about the need for the Federal Reserve to keep raising interest rates or keep interest rates high, and the impact that will have on the economy. But as investors, it's so important to look through just these day-by-day numbers and all of the noise and the comment that surrounds it, and really think about the long term. We're coming out of a very unusual period in the global economy caused by the pandemic and also the terrible war in Ukraine.
Thank you, Dan. Good to talk to you. Dan Kemp there from Morningstar. Well, let's look at China, where the government has announced it will once again start issuing a range of visas to foreigners from Wednesday, seen as a major easing of travel restrictions that had been in place since the outbreak of the pandemic. Let's hear more from Katie Silver.
So it's a major easing that has been announced. We've heard, for example, that they're going to be opening it up to about 4 different categories of people. So first of all, those who had visas issued prior to March 28, 2020 will now be able to re-enter. And some of these, for example, had multiple entry visas that were going to last in the order of about 10 years. They're also going to allow foreigners to apply for visas. And as well, they're going to see visa-free entry in ports such as in Hainan and for cruise ship arrivals in Shanghai. And then finally, they're also going to ease restrictions for those arriving from Hong Kong, Macau and Asian countries. So that is one aspect to it. The other is outbound travel. So Chinese travellers going abroad. And up until now, there's been about 20 countries that group tours were able to go to. And now they're extending this to being about 60 countries. Now, one analyst I've just been speaking with said that they've made the choices on which countries these will be somewhat politically. Perhaps those countries that have been more cordial in their relations with China will find that they have access to this, that they're on that list, as well as the fact that they say that it's been about which countries that airlines feel they're going to be able to get critical mass from. As you can imagine, airlines have really struggled through 3 years of tight COVID restrictions. And so one analyst I've been speaking with, an insider in the Chinese travel space, says that it will be very much so in consultation with these airlines as to where they feel that they may be able to get travellers to go to. Italy was one country that was named as a potential thing. But as I say, what this seems to reflect is it's going to be a staged, slow reopening for a sector that has really felt the effects of 3 years of tight COVID restrictions.
Katie Silver there. That's the business stories. Plenty more to see on our website. Do take a look. But goodbye for now.